Sebastião aí para inaugurar essa versão do Virtual Seminar da SBFin com alunos de PhD que estejam no exterior. Sebastião está em University of Illinois, Urbana-Champaign, está no departamento de economia, mas está trabalhando mais com o Heitor Almeida, que está na Dias School of Business. Então, o floor is yours. Você tem aí 45 minutos para falar um pouquinho do seu trabalho. E a gente guarda as perguntas, o debate mais para o final, e durante a sua apresentação eu vou pedir para que os participantes façam apenas perguntas que sejam para esclarecer alguma coisa pontual. Tá bom? Sebastião, um prazerzão.
Valeu.
Tá contigo aí.
Marcelo, obrigado aí por organizar o seminário, muito legal. Acho que alguns meses atrás a gente já havia conversado aí que para fazer isso para aluno de PhD, então achei uma baita oportunidade de estar aqui apresentando. Até encorajar outros alunos de PhD aí que estão para os Estados Unidos, que quiserem, também no Brasil, o pessoal quiser apresentar, pode entrar em contato comigo e eu e o Marcelo a gente vê uma data aí para apresentações futuras. Vou apresentar em inglês aqui que eu acho que vai ficar um pouco mais fácil. So today I'm gonna be talking about the role of equity financing constraints in the transmission of monetary policy. This is a joint work with my advisor, Heitor Almeida, Timothy Johnson, and Yu Cheng Zhu. We are all from the University of Illinois. So actually we started this project when the Fed was increasing the interest rates during the tightening cycle. So our idea was like, let's try to understand how monetary policy transmits to the corporate sector and what are the channels playing an important role here. So just this motivation. So this figure that I'm showing you is like the survey, Duke survey. It's basically firms' most pressing concerns, and we can see that monetary policy is at the top, right? And this is basically showing that mainly due this recent tightening cycle of the Fed, monetary policy now has been at the top of CFO's concern. And what the literature has basically found is that monetary policy can impact real economy in many different ways. And one key finding of this literature is that contractionary shocks, they lead to lower investment, both at the aggregate and firm level. And one potential channel to explain this transmission of monetary policy to firm level investment is via the financial accelerator channel, which goes back to a seminal paper by Bernanke et al. 1999, with this idea that firms they might forego positive NPV projects due to lack of financing, which is kind of a simple idea. So we have this contractionary monetary policy shock, which affect interest rates. This translates to the firm's cost of capital. Constraints become binding, and this translates to lower investment. And as a result, financial constraint kind of amplify the impact of monetary policy to real investment. So to kind of understand how this full impact of monetary policy, it's crucial to understand how financial frictions shape firms' reactions to such shocks. In order to kind of measure these financial frictions, many studies have tried to done that and to see the role of financial constraints in the transmission of monetary policy to firm investment. And the literature has basically focused on debt-related constraints, which we are going to call in this paper like the debt channel. So in order to try to proxy for financial constraints at the firm level, several proxies have been used, such as leverage, age of the firm or size, in order to try to proxy for collateral, or debt maturity, which tries to proxy for refinancing constraints. And in principle, it makes sense, right, to look at debt-related characteristics, because interest rates has a direct impact on that. So in line with this, we have this paper by Junger et al. 2024, which show that firms' investment is more responsive to monetary policy when a high fraction of debt mature. So this paper uses like the identification strategy from Almeida et al. 2012, which kind of predict firms with debt maturing. So when firms have debt maturing during a negative shock, they are shorter in cash, right? So they should cut investment by more than other firms. And there's also this paper, RFS paper by Osdagli, showing that leverage amplifies the response of stock prices to monetary policy. However, there is actually no comprehensive evidence on firms relying on equity financing, right? So again, as I said, most of the literature has focused on these debt-related characteristics because interest rate has direct impact on that, and there is no evidence basically on firms relying on equity financing. So that's kind of the starting point of our paper. So the starting point of our paper is that more financially constrained firms, they often turn to equity financing for liquidity needs rather than debt financing, right? So there is this pecking order theory in corporate finance, which suggests that equity financing is the least preferred source of financing for firms. And it also implies that firms that rely on equity are likely to be generally more constrained. And as a result, those firms could be more sensitive to monetary policy shock, since monetary policy would also affect the cost of equity. So the big motivation for us here is that monetary policy may not transmit to the corporate sector only through its impact on debt financing terms. So changes in equity financing terms may be a more important mechanism. And that's the big question that we are gonna address in this paper. So we are gonna ask what is the role of equity financing constraints in the transmission of monetary policy to the corporate sector. And we are gonna do so by using a financial constraint measure that is gonna distinguish between financial constraint on the equity and debt financing. So I'm gonna discuss that more, but we are gonna rely on a text-based measure of financial constraint, which are gonna identify whether the firm is constrained or not, and whether this firm is trying to access the equity or the debt market. And we are going to conduct a comprehensive analysis of the heterogeneous response to MP. So we are going to be looking at stock price, investment policies such as CAPEX and R&D. We also going to be looking at the impact on innovation output such as patents and financing policies, which is basically equity and debt issuance. And also one important point we want to emphasize in this paper is that the shock that we are going to use are going to be basically isolated from the Fed information effect. So there is some evidence in the literature that the Fed information effect could bring some bias to the estimation of pure monetary policy shocks. So in this paper, we are going to isolate from that by using a pure monetary policy shock. So basically combining bullet points 2 and 3, we are going to provide in this paper evidence for this novel equity channel of monetary policy transmission. The main results, just a brief preview here. So what we find is that consistent with the literature, contractionary monetary policy shocks, they lead to lower stock returns, a reduction in CAPEX, which are capital expenditures, R&D, and patents. And the new finding is that firms with high FCE, which is equity constrained firms, they show a much larger decrease than unconstrained firms do. Okay, so we find that FCE, which is the proxy for equity constraints, significantly amplifies responses to monetary policy, which we call the equity channel. And importantly, this equity channel seems to be dominant in the heterogeneous transmission of monetary policy. So what we find is that this equity channel prevails after controlling for the debt channel and other debt-related characteristics. So, for example, at some point in the paper, we kind of run a horse race between all common debt-related characteristics that people have used, and also between using the proxy of debt constraints that we have in the paper, and we show that the impact of FC might be stronger. We find that debt constraints also magnifies the impact of monetary policy shocks, but by a much smaller economic magnitude than FCE. And this equity channel is also supported by financing and issuance policies. So what we find is that firms with high FCE, so those equity constrained firms, they issue much less equity after contractionary monetary policy shocks. So just a brief review of the literature. As I said, there is a huge literature on monetary policy transmission to investment, which starts in Bernanke et al. 1999 until more recently. So, for example, this paper by Clooney et al., it's a Journal of European Economic Association paper. They are using they are proxying using age and payout. This paper by Junger, R&R Restud, they are using debt maturity, which with the idea that firms that have debt maturing at the time of the shock react more to monetary policy. And our contribution is to show that the equity channel seems to matter more for the transmission of monetary policy to firm investment. We also contribute to the effect of monetary policy on stock market. So this literature started basically with Bernanke and Kuttner. So they were kind of the first to come up with this idea to use high-frequency monetary policy shocks around the FOMC meetings announcement. And our contribution is in the sense that financing constraints and capital structure, they affect stock price sensitivity to MP, consistent with the financial accelerator mechanism. So again, we show that both FCE and FCD, they amplify the impact of monetary policy to stock prices, but this impact is much larger for FCE. We also contribute to a very kind of new literature on the role of equity in the transmission of monetary policy. So as I said, there's no comprehensive evidence on this kind of equity chain of monetary policy. We have this recent paper by Beyagi et al., which shows that, for example, public firms can issue equity to attenuate the impact of monetary policy shock. And this paper by Beyagi also showed that private firms are the most affected by monetary policy. But for example, they use a sample of firms that are more debt focused. So our contribution here is to be like one of the first papers to show that constraints in accessing equity financing amplifies the impact of monetary policy. We also contribute to this literature on the effects of monetary policy on innovation. And that's something that we are kind of pushing in this paper. So one of the things I'm gonna show is that those FC firms, they are kind of R&D intensive, they have like low leverage. So what we find is a strong impact on R&D. So basically, we contribute here by showing that this equity channel plays a important role for long-term growth due to its impact on R&D and innovation. So again, we find an amplification for the impact on R&D, which is translated to innovation output, which is basically patents. So for the data, again, we are gonna focus on this text-based measure of financial constraint, which is gonna help us to differentiate whether the firm is trying to access the equity and the debt market.
Sebastião, deixa eu aproveitar que você está tomando aí um drinkzinho e fazer a pergunta do Marcos Coelho aqui, que ele pediu um esclarecimento como é que o impacto da concentração bancária na transmissão da política monetária, como é que relaciona com essa literatura.
Yeah, so like regarding the impact of like banks, I don't think there is much like about banks concentration. More on the corporate like finance view, there is some evidence that firms that are borrowing from like banks and therefore they are borrowing like in floating rate, they are more affected by monetary policy shocks than other firms, right? So uh, that's kind of the evidence that we have, which is this paper here, uh, this 2018 paper. So they show that firms that are borrowing in floating rates, they are more affected by monetary policy shocks by cutting more investment and also showing that stock prices are more sensitive. But I don't, I'm not aware of any evidence like on banking concentration and how does that may impact the monetary policy transmission.
I guess it relates more to the literature on banking than on the literature on FinCorp, right? In the
Yeah.
corporate finance.
Yeah, that was actually something that we were kind of discussing when we started to focus on this paper is that, so for example, uh, firms that are borrowing in floating rates are usually like they are borrowing from banks. They should be more affected by monetary policy. But there is some kind of endogeneity issue here because those firms are also kind of weaker firms, right? So it's hard to isolate whether they are being more impacted by the shock because they are weaker and or because of the floating rate. So trying to isolate this floating rate is kind of a challenge here. This JME 2018 JME paper tries to do that. I think they do like a good job. Yeah. Yeah. So going back here, yeah. So for the financial constraint, I'm gonna discuss the text-based measure. For the CompuStat, it's basically where we are gonna get the whole balance sheet information from firms. Stock returns are coming from CRISP, patents from US PTO, and the sample period is from 1991 to 2019. So as you can see here, our period is covering the zero lower bound, but we do not cover the recent tightening. So that's something that we are planning to do, which is to kind of extend the sample at least until 2024 to see if we get this recent tightening period. So for the financial constraint measure, so the idea here is that a firm is going to be considered equity-focused constraint firms if the firm mentions in 10K files that their investments are getting delayed or postponed, and this firm intends to issue equity financing to address these potential liquidity needs. So, for example, that's an example of a company which is kind of classified as a equity-focused constraint. So, should the company not achieve profitability in the near future from the two above mentioned products, additional equity financing would be required. If additional funds are not obtained, the company will be required to curtail its development activities. Okay, so that focused constraints are going to be defined in a similar way, but the idea is that the firm is going to attempt to issue that financing. So how this is kind of constructed? So basically for each firm year, we are gonna have a continuous score on each dimension. So there is a score for FCE and a score for FCD, which is constructed by the cosine similarity of the text in each 10K with firms identified as a constraint. So first, uh, the way this is constructed, first you identify a group of firms that you are pretty sure that they are a constraint, and then you compute the cosine similarity between that and the text in each firm's 10K file. So this is constructed by Holberg and Maximovic, RFS, and was recently extended by this Lin and Wigley JFQA paper. So we are not gonna get into that in the paper, but there's a huge discussion into the literature about which proxy of financial constraint is better. This Lin and Wingley paper, they kind of suggest that this measure can better capture financial constraint behavior than other measures. But our idea to focus on this measure is because we want to kind of isolate the equity channel here and try to distinguish between the equity and the debt channel. So just in terms of notation, from now on, I'm gonna call equity focus and debt focus FC and FCD respectively. How we are measuring the monetary policy shock? So we are gonna employ a high frequency identification strategy, which is basically following this paper by GSS and Bernanke and Kuttner. So the idea is that for each FOMC meeting, we go in a window around that and get interest rates expectations. Okay, so basically, the idea is to get the price change of Fed funds rate contracts in this 30-minute window around the FOMC announcement. And this, as a result, captures market-based unexpected changes in the Fed fund rate. And the identifying assumption is that this narrow window contains no other information that may affect the interest rates expectation, right? So for example, if you think like, oh, oil news might affect interest rates. So the assumption is that in window, no other information are affecting interest rate expectations except the FOMC meeting announcement. And that's something that I already mentioned in the kind of the motivation of the paper. So when we have this announcement by the FOMC meeting, we have this information effect, which is basically that this unexpected monetary tightening might be interpreted as a signal of a strong economy. So what we do is to follow this AJ Macro, Jarosinski, and Karadi paper to separate the peer component of NPS. Okay, so the idea is conceptually simple. So using signer restrictions, the peer monetary policy shock is identified by the shock that leads to a negative co-movement between stock price and interest rate expectations. In contrast, the information shock leads to a positive co-movement between stock price and interest rates expectations. So in the paper, we focus on this pure shock because we want to see basically how those firms are reacting to higher interest rates. All right, so getting into the methodology and results. So we start our analysis by looking at the stock price response. Okay, so our outcome variable here is basically daily stock returns of firm on the day of the FOMC meeting announcement. And MPS here is the standardized peer shock. So we standardize for this shock to be like a 6 unit contractionary shock, 6 BPS contractionary shock. And we are mainly interested in this delta coefficient, which captures the differential response of FC firms, equity-focused constraint firms, to relative to unconstrained firms. So we are interested in seeing this amplification effect by FC firms. We control for a bunch of firm level characteristics and all types of fixed effects here. So just before we get into the heterogeneous response, so just to show you the stock price, like the average response, which is consistent with what the literature did. So we have 5 different types of windows here. So column 1 is on the day of the FOMC meeting, 00. Column 2 is 1 day after. Column 3 is the cumulative 1 day, column 4, 2-day cumulative, and column 5, 5-day cumulative. So what we find is that a contractionary shock here leads to a 51.4 basis points decrease, and the cumulative impact after 5 days is around 1.05%. But that's the new finding here. So we find that equity focused constraint firms have a much stronger amplification effect. So they are much more sensitive, at least in terms of stock prices. So we find that a 1 unit shock, which is, as I said, 6 basis points, leads to a 18 basis points lower return for FCE. This impact is 11 basis points for FCD. And this impact becomes even more pronounced when we look at the cumulative impact. So if you look at the cumulative window, so here, 1 day cumulative, 2 day cumulative, and 5 day cumulative window. So we can see here that like a 5 day cumulative window, the amplification effect is like 3 times greater for FCE firms compared to FCD firms. So uh, um, the impact for FCE is around 48.1 basis points, while the impact on FCD is 15.3. We then look at investment as well. So this first part, we look at this high frequency stock returns response, and we look at investment policies such as CAPEX, capital expenditure, R&D, and innovation. For this approach, we are using instrumental variable local projection for impulse response functions, and we follow this JME paper, and we are instrumenting the 1 year treasury rate using the peer monetary policy shock. And the idea is that the firms, like the monetary policy shock is like the 3 month Fed future funds rate, so it's a short-term rate. The idea is that firms, they usually take decision based on longer rates, right? So that's why we had this idea to use these longer rates, and also better captures the adjustment of investment, which is usually slow moving and measured at the quarterly frequency. And another good point, so this AER paper by Gatler and Karadi, is that our period, which is from 1991 to 2019, we kind of cover the zero lower bound, right? So interest rates were like zero. So the idea here is that the treasury rate better capture monetary policy movements than other like Fed fund rates. We run this local projection here. We are mainly interested in the beta 3 coefficient and beta 4, which basically captures the sensitivity of FCE firms and FCD firms. We look at CAPEX and R&D. We include all types of fixed effect, and also the interaction of all the controls with the shock as well. Just before we show I show the heterogeneous response, this is the average impact. So basically, a 25 basis points higher instrumented treasury rate leads to a reduction in CAPEX of 5.2%, and R&D drops by 1.3 over the course of 3 to 5 years. And we find a significant amplification by FCE. Okay, so FCE amplifies this response by 5%, while FCD amplifies by only 1.5. Okay, so and again, if you remember the stock returns results, the amplification for stock returns, the difference between FC and FCD, they were like around 3 times greater for FC, and here we kind of have a similar thing, and we can see that it's also much more significant as well for FC. We find an interesting finding for R&D. So the amplification for R&D is much larger for FC firms. The amplification is around 17%, and we find no amplification effect of FCD on R&D, right? So only we observe only this amplification for FCE firms. This reduction in investment is translated to lower patents. Okay, so we find that FC firms, they are reducing their patents, and the amplification effect is around 9.3%. And again, we don't see the same results for FCD. Okay, so we kind of argue that the equity channel is potentially important for long-term growth, which is something that there is very few evidence in the literature.
Sorry, just to clarify, why do you choose age equal to 17?
So we chose that because it's right after the impact of R&D here. And it was when the impulse response for patents shows the strong responses. So we did 17 and 18 and 20.
Thanks.
Mhm. So yeah, our idea was kind of to see that this impact on patents are coming from the reductions in investments such as R&D. Yeah, so and again, this is kind of a nice result, which shows that we could have this impact on long-term growth. We provide some support for the equity channel also by looking at the effects on financing decisions, such as the decision to issue equity or debt. So basically, we start here from financing policies. What is the idea? So basically, following higher rates, equity issuance may become more difficult or more expensive, right? So since higher rates is also impact the cost of equity. And in the presence of financing constraints, this could translate to lower investment and in capital expenditure and R&D. So we kind of pose it that if the equity channel is quantitatively important, FC firms might issue less equity after contractionary shocks, right? So if this transmission of monetary policy is happening through equity financing terms, the impact should be very concentrated in equity issuance. So we look at both the effect of monetary policy shocks on equity and debt issuance. So we expect the impact to be mainly concentrated on equity issuance and the impact on debt issuance to be very weak or not statistically significant. And that's kind of the result. So we find that after these 25 basis points shock, FC firms, they issue less equity, of which the magnitude is around 6.9%. When we measure by CEO issuance, the magnitude is around 10%. Okay, so this is a strong reduction, as you can see from the coefficient of the interaction between MPS and equity focused. And we also observe, as you can see here in column 3, a drop in debt issuance, but this drop is much smaller, right? So it's around 0.9% of the average. So in summary, FC firms, they are cutting both equity and debt issuance, but the magnitudes of equity issuance is like 10 times greater. And we do not see a significant heterogeneous response among FCD firms, which is this coefficient here. We also find an interesting impact on cash holdings. Okay, so when we look at what happens to cash holdings, we find that on average, contractionary shocks, they lead to lower cash holdings. But if you see the coefficient of the interaction between MPS and equity focused, we can see that it's positive, meaning that those FC firms, they are reluctant to run down cash holdings, likely due to increased difficulty in raising new cash to replenish, in raising new equity to replenish cash, right? So basically due to this precautionary reasoning, FC firms, they are reluctant to run down their cash holdings.
Sebastião,
And
just to
this,
clarify again. So
Mhm.
when you classify funds as equity focused and debt focused, so you're classifying the whole sample, every firm into one group or the other? Probably not, right? So you have like for certain firms, you know that they have some financial constraint, at least, using accounting
Yeah, so
variables, but you
basically,
cannot really classify them as equity or debt focused. So what happens if you are both equity and debt focused? What happens if the algorithm does not identify whether it's focused on equity or debt?
Right, yeah, that's a great question. So, as I said, like for each measure, we have one score, right? So, so we always have a score for that, and that score could actually even be negative. And the idea we sort by terciles every year to get that. So, for example, the way we classify equity-focused firms are firms that are in the top tercile of FCE and in the bottom of FCD, and vice
Ah,
versa.
okay. Okay.
Yeah, and vice
Got it.
versa.
Got it.
Yeah. So we actually presented the paper 2 days ago or Monday, and we got the comment to do also when they are both, right? So
Exactly.
the reason we don't do when they are both is because we are trying to kind of isolate these equity channels. So that's why we are looking at when one is top and the other is bottom. Yeah, but that's a good question. Yeah.
So like in MPS, for instance, the first row, what you get is the fact of firms that are neither equity or debt focused
Yeah,
or they are both, right? So,
yeah, it's kind of the average impact. Yeah,
okay.
yeah, yeah, very good. Yeah, yeah. So yeah, and we believe that this fact that those FC firms they are reluctant to run down their cash holdings also supports our findings that those firms are cutting real investment by more. One thing we try to do is to rule out this debt channel. So if you remember my previous slide, so we find that FC firms they issue less debt after a contractionary shock, but the magnitude was much smaller than the equity issuance. But one potential concern is that the transmission could still operate through the debt channel, right? So how do we try to rule out here? So we estimate the impact of financing shocks on investment policies. So we obtain two financing shocks, which is these aggregate level financing shocks in equity and the debt markets from this paper by Bello et al. And we interact these shocks with FCE and FCD firms. So what's the intuition and what's the idea here? The idea is that we have two types of shocks, shocks in equity market and shocks in debt market. We expect FC firms to mainly react to shocks in equity market, right? So if investment policies of FC firms mainly react to equity issuance shocks and not to the equity issuance, it's very unlikely that MEP, which is monetary policy, is affecting FC firms' investment decisions via the debt channel, right? So if FC firms are not reacting to that issuance shock, so they are not reacting to changes in that markets basically. So it's very unlikely that MP is operating through this debt channel. We run these impulse response function here for the debt issuance shock. So we are mainly interested in the coefficient beta 2 and beta 3. And we expect beta 2 to be positive, greater than 0, which means that FCE firms they are reacting to equity issuance, and approximately 0 for that issuance. So they shouldn't react to that. We also include the normal controls and all interacted with the shocks. I also we chose horizons 4 and 5, which is when the impulse response function of the average response shows the strongest response. And consistent with the results, we find that FC firms, they are only reacting to equity issuance shocks. Okay, so only shocks in the equity market affect the investment of FC firms. So we kind of believe that it's very unlikely that the transmission of monetary policy is operating through the debt channel, which kind of provides some more evidence for this equity chain of monetary policy. We provide some more evidence for the the aggregate impact of this transmission to FC and FCD firms. So we presented the paper in a conference, and one of the comments that we got from the discussant was like, oh, it might be the case that FCD firms are bigger than FCE, right? So even though FCE firms are cutting investment by more, in aggregate, it could be the case that FCD are more important. So we indeed, FCD firms are larger, but we try to support our findings by implementing here kind of a back of the envelope calculation to estimate this empirical, the heterogeneous impact of monetary policy at the aggregate level. So we do a simple exercise. So first we get the sensitivity of investment to the shock. Then we calculate the changes in CAPEX and R&D following that rate increase. We multiply these changes by the average value of the total assets to basically obtain CAPEX and R&D in dollar terms. And we multiply this number by the yearly average number of firms. So we do for some different horizons here. And we can see from the last row here, the kind of the aggregate effect, which is the total effect multiplied by the number of firms, which is showing that the response of equity focused firms is at least as important in aggregate, despite their much smaller size. Okay, so except for Horizon 4, which FCD firms have a stronger, let's say, average effect. After that, FC firms show a bigger value here. We also show some additional findings in the paper. So there is this literature in financing constraints showing that financially constrained firms, they should mainly react to negative monetary policy shocks. Okay, so we do some asymmetric impacts, and we show that mainly contractionary shocks are the stronger here. So, for example, the interaction between MPS and equity focus is always significant and positive for contractionary shock, but that's not the case for expansionary shock, which again makes sense, right? Because negative shocks are gonna be the ones that are gonna put the firm on the constraints, right? Constraints are gonna be binding. We also do some exercise to exclude the zero lower bound period. So our full sample covers 1991 until 2019. So we excluded the zero lower bound period and show similar results. We use alternative monetary policy shocks as well. So there is several papers trying to come up with and improve from previous literature monetary policy shocks. So in our benchmark results, we build on Jarosinski and Karadi, AJ Macro, but we also use like some novel shocks from Bauer and Swanson, and again, results are kind of unchanged. We control for cyclicality, which is the interaction of GDP growth with the financial constraint, and results are same. We also add those two important controls here. So as I said, those FC firms, they are R&D intensive, right? So, and there's also evidence that firms with higher cash flow duration, they react more to monetary policy. So we interact the shock with duration, include that in the regression, show similar findings. Same thing for intangibility. I touched a little bit about the information effect before. So instead of only using the pure shock, what we do is to also compute the information effect and including the regression as well. Again, our findings are pretty much robust. And we also control for refinancing constraints. So the text-based measure, the FCD, capture the debt dimension already, right? But a lot of the text are based on firms that are violating covenants and etc. So we build on this measure of refinancing constraints, which is the debt maturity, to kind of try to proxy for refinancing constraints. So we add in the regression and the results are basically unchanged. So just to wrap up, I have only 1 minute. So in this paper, we provide new evidence that the equity channel is quantitatively important in the heterogeneous transmission of monetary policy. We find that after a contractionary shock, equity-focused constrained firms, they decrease both CAPEX and R&D, and this is also translated to innovation output. It's also reflected in stock prices, and this equity channel is strongly supported by financing policies, since these firms are cutting equity issuance and they are reluctant to run down cash holdings. And importantly, these findings they hold robustly after controlling for debt focused constraint and other debt related firm characteristics. So the main message we want to deliver in this paper is that contrary to kind of previous motivation of the literature, the transmission of monetary policy to the corporate sector may not rely only on debt financing terms. So actually equity financing terms may be a more important mechanism to explain how monetary policy transmits to the corporate sector. All right? Yeah, thank you very much.
Thank you. So perhaps we should switch to Portuguese
Yes.
if required, we can go back to English. Eu acho que agora a gente pode abrir para as perguntas, para quem estiver assistindo, participando, fazer perguntas. Caso contrário, eu tenho uma lista aqui meio grande de perguntas para fazer e nem todo mundo precisa ficar até o final. Alguma pergunta? Então, vou começar aqui,
Tá.
kick-off aqui, tá? Minha
Uhum.
pergunta zero, já tinha... Meu post-it acabou o espaço, ficou post zero aqui. Você explicou aqui no final que as firmas que têm problemas de equity, aquelas que têm problemas de restrição financeira de
Uhum.
debt são diferentes, né? Você explorou isso
Sim.
em alguns slides agora no final. Mas essas diferenças, ou melhor dizendo, né? A decisão, o fato de uma firma ter chego numa restrição financeira de equity e não numa restrição financeira de debt, é resultado de uma sequência se você quiser, uma sequência de decisões que a firma tomou, né? Ou seja, a fato de você ser FCE e não ser FCD é
Uhum.
endógeno.
Right. Concordo. Uhum.
E aí, como é que você resolve esse problema de endogeneidade?
Então, na verdade, isso não afeta os resultados, entendeu? Assim, essas firmas, na verdade, elas são, como você falou, é endógeno, né? Elas são constrained, são mais constrained do que outras, assim, né? Então, na verdade, o que a gente está tentando mostrar é que o que a literatura estava fazendo antes era pegando características de debt para tentar medir essas financial constraints, essas proxies de financial constraint, mas na verdade o certo é você pegar de equity, porque são essas que são as mais constraint na margem ali, né? E sim, o nosso principal resultado, que é assim, essas firmas que estão relying on equity on the margin, quando bate o choque, esses caras têm que cortar a equity issuance, então, assim, a transmissão de monetary policy acontece mais pelo equity channel do que pelo debt channel, entendeu?
Ah, essa parte eu entendo, mas como você está do lado direito da equação, você está com uma variável que você mesmo diz que é endógena, a condição de ortogonalidade pode não estar valendo, né? E aí as suas estimativas podem ser inconsistentes e te levar
É,
algum
o,
tipo de viés, né?
o que a gente tenta fazer tipo, é assim, existem algumas características que são correlacionadas com FCI e com FCD também, Então a gente tenta, tipo assim, controlar para o máximo que a gente pode, né, de características que são parecidas e interagir com o choque também. Então, por exemplo, eu toquei um pouco na questão de duration, né? Por exemplo, é, FC firms, elas são, on average, elas são menores e elas têm high duration, entendeu? Então, firmas com higher duration, se elas também reagem mais a monetary policy shock, o channel pode ser via duration e não via financial constraints, então a gente tenta address dessa forma, assim, entendeu?
Eu acho que uma forma de você olhar isso também é olhar os efeitos fixos, né? Vocês têm efeitos
A
fixos
gente também bota de efeito fixo
e,
de
e aí
industry.
você olha com efeito fixo e sem efeito fixo e vê o quanto que corrige, né? Eu acho que
É,
tem.
e nem muda tanto, assim, a gente tem
Ah,
uma parte que a gente faz uma tabela do paper, assim, que a gente bota, por exemplo, firm fixed effect, depois firm year, depois firm industry time, entendeu? Então, assim, e os resultados são meio unchanged, assim, até o coeficiente, né?
tá. Deixa eu te fazer uma segunda pergunta antes de abrir de novo aí para a plateia.
Uhum.
Dado que a gente está falando de FCE e
Mas é
FCD,
uma boa pergunta.
essa classificação que você tem, você está usando lá o paper do Lee e mais o nome Wigley, eu acho que se eu não me engano, né?
Foi o Holberg e Maximovic, a RFS, que veio
Isso.
com essa aí, e o Lin e o Wigley estenderam essa sample aí no
E aí o que
paper.
você está fazendo é basicamente usar dados de texto. Eu achei bem legal o jeito que é feito, tá? Mas tem um
Uhum,
paper do Steven Hansen e Michael Macron e mais alguns, acho que dois coautores, bem
uhum,
recentes, né? Eles começaram a fazer isso, talvez tenham sido os primeiros aí.
uhum,
Talvez tenha sido o caos em 33, um dos primeiras edições aí da Econométrica, né? Quando ele era editor, ele escreveu lá uma coisa sobre o Wall Street Journal, tentando olhar o editorial e contava ele mesmo, editorial, palavra por palavra lá que ele queria fazer, né? Mas
uhum,
o Steven Hansen e o Michael McCone, eles têm uma série de papers trabalhando para Banco Central, né? Eles tentam olhar
uhum,
atas e comunicados do Banco Central para tentar identificar aí se é ROCs, se é DOVs, quais são os efeitos e coisas do gênero, né? E
uhum,
eles vêm trabalhando com isso já há algum tempo. E eles têm um paper recente agora, com mais dois coautores, mostrando que você não pode simplesmente pegar variáveis que são baseadas em dados de texto, né? No caso, indicadores que são baseados em texto, e
uhum,
plugar do lado direito da equação, né? Você tem um problema de measurement error ou de classification error, no teu caso pode ser os dois, mas é mais estimation error, na minha opinião.
uhum.
E isso gera alguns tipos de attenuation bias também no teu desvios padrão, e eles mostram exatamente qual é a direção que vai e como corrigir.
Ah,
Talvez
legal.
seja uma referência boa aí para você
Se
dar uma
puder
olhada.
mandar o paper aí, vai
Eu não
ser...
sei se eu tenho um paper, não. Eu dei uma olhada, acho que no NBR que eu li, ou no
Ah,
LinkedIn.
tá. Ah, mas
Dá
é
uma
uma
olhada do
boa ideia.
Steven Hansen, Steven com PH, Hansen e Michael Macron, que até veio recentemente ao Brasil aí para a conferência
Hum,
do Banco Central. Deixa eu olhar
Beleza.
aqui. O José Elias desejou parabéns e deu os seus parabéns e desejou sucesso aos papers.
Ah,
Alguma
obrigado.
outra pergunta ou posso continuar aqui fazendo o meu churrasquinho do Sebastião? Então vamos lá, slide 18. No slide 18 e 19, você tem duas tabelas sobre. E aí você vai comentar qual é a diferença do FCE e do FCD, né? Deixa eu trocar aqui que eu estava na
Aqui?
tabela.
Slide,
Isso.
esse aqui.
Aí nesse slide 18, quando você olha esse 179 aqui, o 110, na verdade, olhando aí para os erros padrão, esses caras não devem ser muito significativamente diferentes, tá? Você chegou a testar, a covariância é negativa, o que vai te ajudar, né? Porque quando um é equity focused, o outro ele não pode ser debit focused, né? Então ele vai ter
Right,
zero
yeah.
no outro. Então vai ter uma correlação negativa aí que vai te ajudar, talvez. Mas talvez antes de falar que tem uma diferença grande, que até tem, não tanto quanto no slide 19, eu acho que vale a
Sim,
pena fazer um teste aí se esse cara esses caras são realmente diferentes, tá?
tá. Boa ideia.
Comentário pedante no slide 20. o on devia estar antes do it. Acho que as pessoas hoje agora, aqui até no Brasil agora falam, eu queria falar sobre, tipo,
Ah,
uma coisa
tá.
que não existe no Brasil, não existe, né? E em inglês existe, as pessoas falam, mas o certo seria falar on which firms make decisions, né? Bem, um
Uhum.
comentário bem pedante, que talvez eu pudesse ter sido feito em outro momento.
Não,
Algum
mas
outro comentário?
obrigado pelos comentários aí, foram ótimos, assim.
Imagina.
A gente tem ganhado uns comentários aí, a gente apresentou na WFA agora.
Aham.
E aí a gente ganhou uns comentários, a gente ganhou esse comentário do duration, mas que era uma coisa que meio que a gente já estava fazendo, assim, antes, que é um pouco relacionado à questão da endogeneidade, né, que você comentou, né? Que podem ter outras características, assim, que... Assim, a gente tenta fazer o melhor que a gente pode para poder isolar esse financial constraint channel, mas, assim, na prática a gente não consegue isolar 100% clean, assim, né?
Mas de repente eu acho que acho que o duration talvez seja até menos importante. Se olhar convexities, talvez você tenha um efeito mais significativo, né?
Uhum,
Porque como a variação do duration é grande, você tem problemas de convexidade muito maior. E é com a convexidade que vem volatilidade, vem coisas desse gênero, né? Que tá incertezas e coisas desse gênero. Talvez olhar convexidade em vez de duration seja até mais forte o efeito, mas vai na mesma linha de qualquer forma, né?
entendi, entendi. É.
Vou dar aí mais 5 segundos para a plateia se pronunciar. Caso contrário, agradecer aí. Opa, Guilherme, obrigado, cara. Senão parece que eu estou aqui monopolizando o Sebastião, coitado.
Cadê?
Obrigado, Marcelo. Parabéns aí, Sebastião. Muito boa
Obrigado.
apresentação e achei bem interessante o paper. Eu acho que nessa linha que o Marcelo questionou também, a questão da endogeneidade ali, da, da condição da empresa, né? Ela não chegou nessa condição por acaso, há vários outros fatores que contribuíram para isso, e talvez isso explique a redução no investimento. Eu queria saber se em algum momento vocês pensaram talvez em estudar também se o pure effect tem um efeito negativo, porque de fato há uma correlação ali negativa entre a taxa de juros e o desempenho da economia, né? Então tu tá vendo que é um choque, digamos assim, contracionário e tu observa lá uma queda no investimento que é mais acentuada entre essas empresas que tu identificou como dead ou equity constrained, né? E se eu olhasse para o information effect, né? Quando a correlação é positiva, então, entre o mercado acionário e o choque sobre os juros, né? Sinalizando, então, na verdade, que a taxa de juros está respondendo a a economia mais aquecida ou que vai se aquecer em breve, né? Eu
Uhum,
deveria observar, então, um efeito contrário, né?
uhum,
Nesse momento, então, essas firmas que estão restritas, elas ganhariam uma folga e, na margem, investiriam mais, respondendo a um choque positivo, né? Eu sei que houve um aumento ali na taxa de juros, né? Houve um aperto monetário, mas ele seria em função de um aquecimento da economia. Nesse caso, eu deveria observar o efeito contrário do que vocês encontraram para o pure effects.
e a
Faz
gente,
sentido essa
não,
minha.
então, a gente acha, assim, na verdade, né? A gente faz até como um validation test, né, no paper, assim, uma sessão em que a gente usa o information shock, né? E a gente mostra, por exemplo, que o sinal para stock price, ele é revertido, entendeu? Em linha com o que você tá comentando. Exatamente, é.
Boa,
E
boa.
era por isso que estava tendo que a gente tenta meio que no paper separar esses dois tipos de choque para justamente não trazer nenhum tipo de viés assim para as estimativas do choque.
Se eles são tão frequentes quanto o outro, né? Até
É,
anularia eventualmente o efeito, né? Eles combinados zerariam, né?
exato.
Eles netariam, digamos assim, né?
É.
E chegaram a fazer também algum teste placebo, assim, estudaram eventos em que não há um choque, né? Em vez de usar o.
Então, é que na verdade a gente está fazendo tipo, é um firm level panel, né? Então, assim,
Uhum.
o choque, ele tem praticamente todo quarter, entendeu? Assim, a gente tem os FOMC meetings, né? Então, ao redor dos FOMC meetings, a gente olha pro choque lá. E aí, assim, por exemplo, quando a gente vai fazer o impacto no stock price, é geralmente no próprio dia mesmo do choque. Quando a gente vai fazer em firm level investment, a gente meio que agrega o choque pro quarterly level. E aí faz isso, é. O que a gente tenta fazer, que eu acho que é um pouco na linha, assim, do que você está comentando, é que a gente tem uma parte do que a gente faz como objetivo, a gente exclui o período do zero lower bound, que é quando o interest rate estava perto de zero ali, entendeu? Aí é que acho que é um pouco início, mas o que a gente fez é que a gente excluiu, a gente não chegou a estimar o efeito só no zero lower bound, que é uma coisa que a gente pode fazer, que acho que é tipo um placebo, né? Assim, provavelmente o efeito vai ser mais fraco ali, né, nesse período.
Show de bola. Obrigado aí pela oportunidade e mais uma
Obrigado aí
vez, parabéns
pelos
pelo paper.
comentários. Valeu.
Obrigado, Guilherme. Então, acho que com isso a gente encerra nosso seminário. Acho que o Anderson pode parar de gravar.